What do you think about corporates putting Bitcoin on their balance sheet?
I think it makes sense, especially in the way that Square is doing it, because I mean, Square has something like 5% of their cash in Bitcoin now, and so if they don't really have to care about the volatility, right? So if Bitcoin gets cut in half or if it doubles, it's not the end of the world, for their profit. But it basically hedges the rest of their cash position. So if there's a big currency devaluation, people flock into Bitcoin, Bitcoin goes up 10x, and their cash position kind of loses purchasing power. Well, that small Bitcoin position just basically protected their entire cash position. But they don't really open themselves up to, if say Jack Dorsey's wrong about Bitcoin and it ends up being a bearish thing, he kind of doesn't make money in the long term on that position. He took essentially no risk by doing it. Whereas MicroStrategy went all in, which is, of course, if Bitcoin goes up 10x, then you've utterly transformed your company. But if Bitcoin doesn't do well, then Michael Saylor is open to, all sorts of issues from that. And so I think, for many corporations, it makes sense to do what Square did, where if they're not hardcore, like they haven't gone down the rabbit hole and they're like super high conviction on Bitcoin, but they've gone down enough to see the value there, and they say, okay, it makes sense to have a non-zero position. And that's also what I've in my public articles on Bitcoin been proposing since the summer of 2020, that whatever percentage you want to hold, probably zero is not the right percentage. And so I basically was advocating for non-zero positions, and then people can dial that up based on their conviction, based on their own unique circumstances, but that zero is probably not the right number.
I mean, tell me, how do you think about modeling Bitcoin? What is driving the price increase? What are some of the inputs that go into your thinking?
So I think the biggest determinant is that 4-year cycle, and that adoption cycle. And so what I've generally found is that Bitcoin has these temporary correlations, that's kind of noise along that path. So it can be correlated to the inflation versus reflation trade, right? So when you have kind of a risk off day where the dollar strengthens and you have kind of a risk off move in stocks, generally Bitcoin doesn't do great those days. And so and also, like, if you have a liquidity crisis like we had in March 2020, Bitcoin gets hit, harder than anything else pretty much. And so it's vulnerable to liquidity shocks. It's vulnerable to these kind of risk on, risk off days. It largely follows its own cycle. And so, for example, real yields bottomed in the end of August 2020. That's when they went down to negative 1.08% if you measure the 10-year yield compared to 10-year break-evens. And that's also when gold topped, at least temporarily. So gold's been in a big correction. We also saw a local top in a lot of those NASDAQ names. And some of those managed to then slowly push to new all-time highs later in the year. But that still was a pretty significant top for some of them, along with gold having so far been the top. And so you already saw that kind of shift away from those long duration names, and when yields started going up from August. But ironically, that's when Bitcoin took off. And so Bitcoin totally decoupled from gold and from those other names. Now, in the past several weeks, it's been somewhat more correlated with those names, and that again, that makes sense. I mean, Bitcoin has these temporary correlations, but really, what's going to drive Bitcoin is the level of institutional adoption and retail adoption. And so, if the overall numbers of buyers keep being interested in buying more Bitcoin, if corporations want to hold it as maybe not like, say, MicroStrategy where they convert their entire treasuries to Bitcoin, but more like Square where they want to have some of their kind of reserves in Bitcoin as a hedge, that can continue driving Bitcoin. And so overall, I think the long-term thing, in any given kind of 4-year cycle is that supply shock, the ongoing demand, and then the question of, what accelerates demand or what kind of holds demand back. And then it's only those kind of temporary correlations that you have to worry about if you're, say, a trader, if you're leveraged, or if you're just going to manage your position size relative to your other assets.
So talk to me a little bit about how you view the relationship between Bitcoin and gold. Are there situations where you might want to own gold but not Bitcoin, or the other way around? Just in general, what do you think about the relationship between those two assets?
Well, there's certainly an overlap. There's an overlap in the community a little bit. There's also, animosity between the two communities.
Before we continue, help us by smashing that YouTube like button and subscribe now to this channel. This shows the algorithm that you value the information, and it helps us spread this message. Sharing is caring. Please like and subscribe now. Thank you. And now, let's continue.
But really, there's a couple assets you can hold that are completely outside of the financial system. And so when you're in the financial system, you're subject to counterparty risk. You're subject to business hours, right? So it's like I have to ask permission to get money out of my bank. I have to ask permission to get money out of my brokerage. Whereas like, if you have physical coins and bars, that's in your own possession. And similarly, if you hold a wad of cash, it might not be the best long-term value, but that's, one of the best things you can have if you just absolutely need something off the grid and that you need to, spend money right now, a wad of cash, and then Bitcoin. So Bitcoin is a self-custody thing. You don't need anyone's permission to run it. Now, I mean, I can imagine situations where you'd rather hold gold. I mean, if your entire area lost power and, you want to have like gold or silver or cash, that's where you want like some of those things. Whereas Bitcoin's great because it's mobile. And so if you want to transfer wealth from one country to another country, good luck with gold, getting that through an airport in any kind of reasonable size. Whereas Bitcoin, you can have it on your phone, you can have it on a little USB drive, you can have it you can memorize 12 words and go through, and basically you have completely mobile wealth. And so they each have different use cases. Obviously, Bitcoin as a smaller, newer, higher performing asset class is kind of it's the new kid on the block, and so that's taking market share. Whereas gold's the more kind of traditional store of value, scarce asset. And so I still like having multiple types of stores of value in my overall net worth. So I have gold, I have silver, I have Bitcoin, I have other commodities, exposures like that. So I have uranium exposure, I have copper exposure, I have energy exposure. And so I've kind of diversified my inflation hedges, and I've also diversified my off-the-grid hedges, so gold, silver, platinum, Bitcoin.
So let's talk a little bit about inflation, because there are sort of two narratives that are out there. And one popular narrative goes like this, right? People just kind of say, okay, we're going to let inflation run hot for a little bit, right? And that's going to reduce the real value of the debt. That's going to act as sort of a transference of wealth from people that have financial assets into wages. And that's going to kind of rebalance everything, right? And then there's another group of people that say, well, hold on one second. If there's inflation, that's actually a sign that the government is broken, right? And when there are periods of rampant inflation in history, you probably wouldn't have wanted to live through a time like that, right? Because it means something is fundamentally flawed in the economy, and times of inflation tend to translate into social unrest or some really unpleasant stuff. So, if we do get some type of inflation, what are your thoughts on what does that actually look like?
Well, I think that's the big question, because it's going to, basically depending on what kind of inflation it is, how big it is, it's going to get messy, because the Fed can't really raise rates too much, because then the fiscal government is paying, increasingly high yields. We already talked about the numbers. I mean, if you pay a little bit over 3% average yield on a $30 trillion debt, you're paying $1 trillion in debt. In interest per year. And so they're basically probably going to be locked into a situation like the 40s, where they have to, basically suppress yields almost regardless of what inflation does. That's, that has consequences. And I think, they can talk it down. Like they can say, they're not going to say outright, okay, we're gonna inflate away the debt, and bondholders are going to be screwed over. It's funny because they're if you read their meeting minutes, they are pretty like blunt in many ways. They're like, hey, we want to keep yields low, so we're going to potentially buy more long end of the curve. Like they're just kind of, and they're saying, okay, yield curve control is on the table as an option, but they'll never say like deficit monetization, and they'll never say, we're going to hold yields low to inflate away part of the debt. There's certain like sentences they can't say, but they can say, okay, we think inflation is going to be transitory. So even though I know inflation looks high, let's say we get a 3% print, like I know it looks high, but it's not going to be persistent. So we're going to hold yields at 0. And then when it starts to become persistent, that's when it gets kind of messy. And I think that's going to be kind of the needle they're going to try to thread. And I think they might then try to tighten, but then they run into one of those other problems where then something crashes or breaks, and they don't really have a choice but to stay dovish even when inflation's hot. And that's the big risk. That's when you get an outright currency devaluation where, gold, Bitcoin, commodities basically soar in dollar terms.
What to do in such a situation? Inform yourself and keep your financial education strong. We from the Compact Group offer our loyal subscribers a free educational portal with first-hand monetary, financial, and economic knowledge. Enter our invite-only Insider Club by clicking the link below. You will get access to first-class information far earlier than the rest. We have prepared a special deal for all our members where you can access a giant pool of Robert Kiyosaki's financial wisdom for just $1. To find out more, simply click the link below and join our Insider Club absolutely free. But there is more you can and should do. build up several streams of income. More and more people realize that they have to take their future in their own hands, but they don't know how and where to start. We from Compact offer our Insider Club members unique opportunities. Strengthen your financial muscle and get the edge. Click the link below. Become part of our free Insider Club. No financial obligations. But there's one important thing you have to know. You have to become active. So do it now. Become active and see you on the other side.